Welcome to the Burn Your Mortgage Podcast, a Canadian real estate podcast that shows you how to pay off your mortgage sooner and live well while doing it. Now, here's your host, Sean Cooper.
Welcome to the Burn Your Mortgage Podcast. I'm Sean Cooper, and it's great to be back for another episode. On today's show, I'll be talking to Ben Myers. Ben Myers is president of Bullpen Consulting, a boutique real estate advisory firm that works with landowners, developers, and lenders to better inform them of the current and future macroeconomic and site-specific housing market conditions that can impact their active or proposed development projects. With over 15 years of real estate research experience, Ben has established himself as an industry expert and a go-to source for the latest information and insight on the domestic residential housing market. Ben has appeared on BNN, CBC, CTV, TVO, Global, and CP24 discussing the housing market and has been quoted in the Wall Street Journal, New York Times, Globe and Mail, and the Financial Post. In my interview with Ben, we discuss what's driving the condo market in the GTA and other big cities in Canada, the important role that the housing market plays in our economy, and what can the government do to help keep housing more affordable for the Canadian middle class. Without further ado, here's my interview with Ben Myers.
Hi, Ben. How are you doing today?
Hey, Sean. Thanks for having me on the show.
Wonderful to chat with you. Great. So let's dive right in. Ben, I'd be curious to hear your thoughts on the new home market. What are some things to consider when buying a new home?
Well, I guess the first thing that I always tell people is to do a lot of their own research to really understand, what type of product they're looking for, how much they want to spend. So take some time going on, a website like Buzz Home, talking to a realtor that does a lot of work in the new home business. Obviously, talk to a mortgage broker, understand what you can afford, and if you're buying, a unit for an investment, understand, where values are going to be in the future, where you think rental rates are going to be, and really understand your costs from condo fees to taxes to accounting for vacancy, accounting for damage to the unit, and accounting for your own time to manage that unit. So those are the things I always tell people to do their own research, and there's a lot of great resources out there to do so.
Great. And those are so many fantastic points that you've raised. And just curious, in terms of the new home market, there's so many interesting data points out there, and you seem to be on top of all that stuff. Is there anything interesting going on right now that you'd like to share with the listeners?
Sure. It's definitely a tale of two markets. We have the low rise or the ground oriented housing market, the single family housing market, whatever you want to call it, singles, semis, and row. Most of that is being developed in the suburban markets. The market's finally starting to come back. We had definitely some bubble-like conditions in 2017 where pricing in that low-rise market in the GTA went up 45% in a single year, just unprecedented growth. We had the Fair Housing Plan come in, and part of that was a foreign buyers tax, and that really got rid of the investors in the market. They hadn't typically been involved in the low-rise market for a long time, just because they just don't pencil. It's hard to buy a 1.5 or $1.6 million single family home and expect to rent it out and be cash flow positive. But because pricing was going up so quickly, people got in and started buying and sent prices even higher, and it sent supply to less than 1,000 unsold units in the marketplace. And just for some perspective, in 2002, I think it was about 17,000 unsold units. So, huge decline. So there hadn't been a lot of activity in 2018 as developers were building those homes, and they didn't want to release new product at lower pricing because that they thought it might impact their closing. So a lender might see that the value of those homes were down $200,000 and not be willing to give a mortgage to some of their existing purchasers. So that was a big concern for them. So now essentially everything that was pre-sold in 2017 in that market is now complete. So developers are now coming out with product. The more new product that's launched, the more sales that happen, the better the market starts to look. So there's a big change in the low-rise market. On the high-rise market, even though there was huge growth in 2017, we're talking 25, 30% price growth, they didn't experience the same drop off in activity. In fact, in 2018, prices went up another 15%. We're seeing some cooling off of pricing in that marketplace, which is direly needed, and different factors in that market. Because there was 35,000 sales in 2017. All of those projects went for construction financing in 2018, and a lot of them got under construction in 2018, and there just wasn't enough construction companies to manage all of these projects. So, what do? They start raising their prices. People are having to bid for their services. So that drove up construction costs. And what we get what's called cost push inflation. So not only were construction costs going up, but what we call soft costs. So development charges, parkland dedication fees, building permit fees, they were all going up. So it was really forcing developers to set their pricing a lot higher than they probably wanted to. I work for developers, lenders, landowners, and I help them, kind of determine where the market value is for their project at this point in time. And I'm telling them, this is what I think you should sell your product at. And they say, Ben, I can't sell it at that. I can't make any money because of what's happened to construction costs. So they've had to, test the market at even higher prices. And so it's been really different dynamic in the high rise market. But, in the long run, I fundamentally believe in Toronto. I think values will continue to go up because there's only so much land downtown. There's only so many construction companies. There's only so much construction finance dollars to get these projects going. So I think we're just going to be in a permanent situation of undersupply in the marketplace. And I think that's going to, continue to send prices up. I mean, there's going to be volatility. There's going to be years where pricing goes down. But over the long run, which I think a lot of the investors in the market now are seeing or are looking at long term as opposed to, flippers or looking to sell right at occupancy. So that's kind of my take on both of the new home markets. I know it was a really long answer, but hopefully that helps out some of your podcast listeners.
Well, perfect. Thanks for mentioning so many interesting points there. It actually segues perfectly to my next question. So I remember reading an article a while back about how Toronto has more cranes than anywhere else in North America. What's driving the condo market in the GTA and other big cities in Canada? And do you see this pace continuing? I mean, I would think that the mortgage stress test has something to do with that, but I'd be curious to hear your thoughts, Ben.
Yeah, certainly a lot of factors. I mean, just going back 15 years, they put in what's called the growth plan for the Greater Golden Horseshoe, and the Green Belt came in, which essentially took out a huge portion of land for the greenfield developments. So that forced a lot of people to look at different areas. And so that caused a boom in the condo market. And then another big factor is just it's so difficult to get around the GTA, right? So even if you wanted to live in Bowmanville and work downtown, it's really just not an option, right? You just can't, you'd be in your car for, 2.5 hours every single day, one way. So it's just not an option. So it's been driving, growth in the downtown areas and places that are close to jobs. And that's essentially just fed off each other as these areas that were previously just factory lands, they became much more desirable places to go. And again, there was a planning change essentially, and I'm not sure quite when it was, which allowed more residential downtown. There were certain areas of downtown where only office was previously allowed. And then when they allowed developers to do residential, then, they started to do residential. And so it's really fed off itself. But, more recently, we continue to have the population growth. I mean, you'll see any developer that talks about this stuff, on the radio or on television will quote the number 100,000 new residents into the Greater Toronto area, or population growth, not necessarily new residents, but population growth every single year. Last year was 125,000, which was the largest it's been been in several years. People want to be downtown. They want to be where the action is. They want to be where the jobs are. They want to be where the single people are. They want to be where the amenities are and transit. They want to get rid of their car. And so just downtown has been a very desirable place to be. And now, investors have seen after, essentially since 1995. So, we've got this huge 15, 20-year track record of price growth and rent growth in the marketplace, and they just continue to buy. They believe in Toronto. They believe in real estate values continuing to go up. And they don't see any change that's going to really drive down values in the marketplace. So, those are a lot of factors. Obviously, recently the stress test it's kind of a double-edged sword. A lot of these investors do want to eventually sell their units to end users, but now because the stress test makes it more difficult for a lot of buyers to qualify for a mortgage and buy a home, well, it just causes a bottleneck in the rental market, which is driven rents up by double digits in 2018, and they're probably up 7-8% in 2019. So it's making their cash flow on some of these rental units that they've purchased look a lot better, and maybe they're going to hold on to the units for longer than they would have previously.
Yes, definitely a lot of perhaps unintended consequences from all these policy changes out there.
Yeah, I mean, there's always things that come up. A perfect example is rent control. I mean, people want it. They don't want to pay. They don't want to see their rents go up 7-8% a year. And so they talk to the municipalities and they talk to their politicians and say, we want this. And it's great for the people who get it. But unfortunately, landlords can set any rent that they want on vacant units. So the people that have rent control stay in their unit because they're paying so much less than what the market value is. And then the rest of the people have to pay these even higher rents for the units that are available. And, and then when a developer who is looking at doing a rental and says, is it going to be 1.5% increases in my rental rate? Is that all that's going to be allowed? Do I want to make that investment? Should I put my capital somewhere else? Just recently running the numbers today for a client, looking at the increase in rental units under construction. In 2017, it was 4%. That was it. And that was the year that they put in rent control. This year, it's up 18%. The 2 years that it was before rent control, it was up 20% in each of those 2 years. So it makes a difference. It's unfortunate that the market is so out of control. I mean, I feel sorry for people who can't get into the market. I mean, I know how tough it was when I was looking for my first rental 15, 20 years ago. And I was, it's like, oh my God, I can't believe I have to pay $800 a month for a studio suite. Like, this is crazy. And now, one bedroom is $2,300 on average, right? It's just huge growth of the last 15 years. But unfortunately, the market can be difficult, and hopefully, there'll be additional policy changes that can, open up additional avenues for more rental construction.
Now, we often hear experts weigh in on the housing market. Some are optimistic while others are less optimistic, dare I say, pessimistic. If you're a home buyer in the market right now, how much weight should the opinions of expert carry in your mind, and should you perhaps take it with a pinch of salt?
For sure. I mean, we saw what happened in 2017. I mean, prices went up in the resale market 35, 36% year over year. And so it's just unsustainable growth. We didn't know how long that was going to last, but we had a pretty good idea that it was going to result in prices coming back down. It went from, I think it was 760,000 was the average price in the GTA in December of 2016, and that went up to 920,000 by the end of April. So it was craziness. And yes, if you look to some analysts and some realtors, they were still bullish. They're like, hey, yeah, come on, keep buying, right? The prices are going up like crazy. And then other people were saying, well, this is a bubble. Prices are going to come back down. So you do have to be careful. You have to look at someone's track record, right? And that's the point I will always make. If they're just every single report they've ever written as saying the market's going to crash, well, I mean, you just can't take that person seriously. People have to take the latest data and information and come back with a new thesis. You have to be constantly reworking your mental model of how the market works, right? I mean, my advice to anyone is it's just not to try to time the market. It's just so difficult to do, right? Maybe when prices are up 35% year over year, maybe be pretty cautious about buying at that point in time, but it's just so difficult to time the market. And I think you shouldn't be buying unless you see yourself living in that unit for 5 years or longer, and then the transaction costs just don't make sense. So that's my advice, because it's just impossible to forecast the market. There'll be people out there that say, "Oh, I knew exactly that was going to happen. Oh, I knew exactly," but they didn't. They didn't. So always take a look at both sides. I mean, I tend to be bullish, and maybe I'm too bullish. Maybe I'm too enthusiastic about the market. So there's always going to be the journalists that are looking for both sides of the story. So I don't think you'll have that much difficulty, finding someone with a different opinion.
Yeah, it's a great point. I mean, my personal view is if you're planning to invest in the real estate market long term, and this is your principal residence, then in terms of whether prices are higher now or in 2-3 by, I think that's really irrelevant. If you're planning to stay in the property long term, then besides the time where home prices are going up 35%, I don't think that should be overly big concern. I mean, I think your big concern should be, can I afford the carrying costs of the property? Because at the end of the day, when you sell the property eventually, if you move on to another property, it's going to be a bit of a wash because you're buying and selling in the same markets. I would just say, your main concern should be, can you afford the carrying costs of the property? Am I not going to find myself house rich, cash poor, rather than timing the market? Because I mean, unless you're like a flipper, then I don't really think it makes sense to time the market, in my opinion.
Yeah, that's correct. I mean, other than, the 1989 to 1994 period, I mean, if you go back, 30, 50 years, any 5-year period, prices have been higher after 5 years, right? So you always have to make sure you're buying with that longer time frame in mind. So, I mean, that's always gonna be my advice.
Now, it's been said many times that real estate is a driver of the Canadian economy. Can you talk about the important role that the housing market plays in our economy?
Sure. I mean, I think people have a lot of pride in home ownership. When they go out and buy a home, it's a sign that the market is doing well, right? That they're have a steady employment. They feel confident in that employment moving forward. And then typically when they move in, they're paying for a moving company. They're go in and they'll slap some paint on the wall. They'll buy some new furniture. They'll pay the moving company. They'll pay a commission to a broker or to a real estate agent or to a lender. They'll go out and buy some new appliances and some kitchenware and all those things that come with the spin-offs that come with with purchasing a home. When you rent, yeah, you might not go out and paint the walls in your rental unit. You might even be allowed to paint the walls in your rental unit, right? There might not be the same level of commissions getting paid for you transacting on those units. So I think the home ownership market in the transaction market really drives a lot of dollars in the marketplace. And then obviously the new home market, we want to continue to be building a lot of homes. I mean, if we're going to have 125,000 people coming into the marketplace every single year, we're going to have to deliver 40 or 50 or even 55,000 new units on an annual basis to accommodate that growth. I mean, people were always talking about, well, we only need 35 to 40,000 units, but the size of the units have changed. The number of bedrooms in the average unit has changed. So you have to adjust that expectation up. So it's probably closer to 50 to 55,000 units. And when you're building that amount of units, you're creating planning jobs, and you're creating jobs for construction workers, and you're creating jobs for architects, and you're creating jobs, for lenders and planners and suppliers and designers and just so much spin-off benefit from creating new housing. All right. So, and yes, there are some negative externalities when someone's favorite restaurant gets torn down, or that parking lot that you used to park at is too busy, or the subway is busier than I want it to be, or maybe there's a slight shadow on a park somewhere. But the net benefit, I think, is hugely positive, for the marketplace. And in the more supply that we create, the less pricing goes up crazy. I mean, I always prefer a stable marketplace. Kind of 2, 3, 4% growth is every single year is kind of a benefit for everyone. As prices continue to go up, developers will be interested in building, lenders will feel confident in lending, and people will feel confident in buying. If it's going up too high, then people get nervous. If prices are decreasing, then people get nervous as well, right? So it's a kind of a sweet spot in the marketplace that keeps everything going. I mean, we've been a good market essentially since the mid 1990s. So it's been a really unprecedented new home market. Obviously, there's been a few more blips in the resale market than there have the new home market, but otherwise, it's been fairly solid. And really, obviously, it's the business that I'm in. I hope it continues to go strongly, but I want it to be a stable market. I don't want it to be a crazy market that gets out of control, hurts affordability for everyone, right?
No, I agree completely. I mean, being a homeowner and seeing 35% price appreciation is nice, but I know that's not a healthy market. So certainly, I wouldn't want to see that for the long term. That's for sure.
Yeah, and there's a lot of people. I my first home that I bought was a condominium, and then we said, what, we want to start a family, so we're going to try to buy something bigger, and we bought a townhome, and I think my wife was always dead set on wanting a single detached home, right? And even though the value of our home has doubled, well, guess what? A single family home has gone up way more than that. So we're kind of, I don't want to say trapped, but because we don't want to go crazy. We don't want to take on a huge mortgage. I don't want to be paying off a mortgage till I'm 75, 80 years old. I mean, obviously, you're an extreme example of paying off your mortgage quickly, but we're on the 25-year plan, and it's just unfortunate, right? It's better to have some steady growth and consistent growth, so people can move up and new people can cycle into the marketplace, right? I mean, that I think is the way that we have to do it. And yes, there's always going to be people who say, well, why are we building new housing? Because new housing is expensive. But it's the way it is. Materials are expensive, labor is expensive, land is expensive. And yes, we probably should be building some social housing, because we just need to get more rungs on that ladder. We need to put as many rungs as possible on that ladder to accommodate as many people as we can.
It's no secret that home prices are a lot higher in major cities than they were just a decade ago. We've touched on some of the reasons why, but in your opinion, Ben, what can the different levels of government do to help keep housing more affordable for the Canadian middle class?
One of the things that people really ignore when they're looking at housing markets is that house prices are comprised of two things: the cost to build the physical structure, and the land price, right? So when markets start to get built out, when they start to be huge markets like Toronto and Vancouver, the price of the land actually becomes higher than the price of the physical structure. And that's a hard thing for someone to understand. And land is just not competing with, it's just not a residential thing. There's people who want to build hotels, and there's people who want to build, commercial buildings and industrial buildings, and they want to put in parks, and they want to put in roads, and they want to put in baseball fields and recreation and keep green space. So there's a lot of competition for that land market. So it's not going to go up at the same pace as incomes, right? There's very limited land. So the best thing that a municipality can do is to ensure that you're fitting as many units on the limited land that you have, right? In the city of Toronto, we have an area that's been described by a planner, I think his name is Gil Meslin, as the yellow belt. So essentially only single family homes can go there, or in some instances, only semis and towns can go on these lands. I'm not an expert on it, but essentially you can't build any high rise. It prevents developers from going in there and assembling a bunch of lots and turning 3 to 5 single detached homes into 25, 30, 50, 100 apartment units that are significantly more affordable than those single family homes. So that's the biggest thing, is to allow the free market to operate for a developer to add additional units into the marketplace and take out some of the more expensive units in the marketplace. I mean, that makes perfect sense. They've done some fantastic measures in allowing these ADUs, or accessory dwelling units, laneway suites, allowing for basement units. Those are essentially the cheapest ways that we can add supply. Wood frame, no additional infrastructure required, and just pop those additional units in, and they're great rental units. But as we've moved away from that greenfield or low rise development in the suburbs that everyone's kind of used to, the subdivisions where land was cheaper. The farther you went out from the city of Toronto, land got cheaper. You could throw on a wood frame house, and the costs to build that house were minimal. Not minimal, but not as high as it takes to build a 50-story tower made out of concrete and glass, where you're going down 5 stories, and it takes 5 to 7 years from when you buy that land to deliver the final product. It requires more upfront sales, which essentially is more risk, meaning developers need more return. Lenders want more return because of the additional risk. And that all just drives up the price, right? So the price per square foot to deliver a condominium apartment versus suburban low-rise home is significantly different as well, right? So that is a huge factor that's taken to our market and driven our market to kind of these obscene levels. I mean, and not even getting started on the low interest rates and how that has kind of added fuel to the fire of where pricing has gone in this marketplace. So I think allowing more supply in several markets, kind of reducing what we call the NIMBYs in the marketplace, the people that are fighting against new development. We really have to reduce that. We need to reduce some of the fees on new housing, because they always talk about growth paying for growth. So these new housing have to help pay for subways and schools and stuff. But a lot of this stuff is going to be used by existing residents too. So what we should do in the city of Toronto is, I know some people don't like to hear it, but we need to have higher property taxes to pay for additional, subways, additional transit routes to move people to markets that have lower values, and to improve, and more importantly even, is to improve the economics of development in those areas. So you can drive through Scarborough's, massively huge, former municipality, and there's hardly any development going on there. And it's really because developers can't charge high enough for the properties in those areas. So we need to improve the transit to those areas so you can quickly move to where the jobs are, and you'll see more development. So, I mean, those are kind of a couple of my big things that I always talk about. More transit needs to get built. That'll jolt new development, and then we have to allow development everywhere in this city instead of protecting the low-rise neighborhoods and protecting affluent home values, which has created the type of inequality that we have in the market right now.
A while ago, you wrote an interesting piece about how developers aren't offering 3-bedroom condos. Are we seeing more family-size condos these days?
Well, we are seeing more family-sized condos, but I don't think we're seeing many more family-sized buyers, unfortunately. And some of those units are going to, more affluent trade-down buyers in the marketplace. They're cashing out of their Forest Hill or their Leaside homes or the Annex homes, and trading down their $2 to $2.5 million home and buying a $1.5 million condominium apartment with some water views or on upper floors or some boutique building. I mean, fundamentally, there's a couple problems with the 3-bedroom units. One, once you start to get to 1,000 square feet, which is, I think, generally what a family wants to get. They want to get at least 1,000 square feet if they've got a couple kids, the amount of storage that you have to have. So now that you look at pricing in downtown, you're talking, $900 to $1,200 a foot, and sometimes, even as high as $1,700 a foot. So just even at $1,000 per square foot, it's $1 million, right? And then you look Other places in even in the city of Toronto, within walking distance of transit, you can get a townhome, a small townhome. And it's probably 1,200 to 1,600 square feet for $1 million, right? So it just makes more sense for them to, move out a little bit farther from the downtown core, maybe, a 20-minute subway ride or a 25-minute subway ride, and buy that $1 million place, as opposed to a smaller downtown condominium where they may only have one parking space. They've got the condo fee. They've got to, bring the kids up and down the elevator. They got to park in the underground and take up their groceries up the elevator as well. And then downtown, the cost of daycares is a lot higher in these downtown spaces because it costs more to lease the space. So the daycare providers have to charge more. And then, how does your child get to school? Are you comfortable putting them on transit, or are you, fighting the downtown traffic to get them to school, or to their soccer practice, or to their baseball practice, or hockey, or what have you, right? So the infrastructure is not quite there yet, and the value proposition is not quite there yet. There needs to be the point where that townhome costs $2 million. Right. So someone will say, oh, yeah, absolutely, I'm going to buy that townhome for $1 million because it costs $2 million for a townhome, even within half an hour of downtown core. Right. So we're slowly going to see it. I think more people are going to get used to living downtown and what that's all about. And we'll start to get more daycares, and we'll start to get more, of the family services. You're starting to see them in some of the condo buildings. They're putting in playrooms and kid-friendly amenities, and they're doing kid-friendly and family-friendly programming in the buildings to make it feel a little bit more like a community. So I think we're slowly going to see it, but I still think it's a very long way off before we start to see a lot of developers do large-scale units. And as long as I've been tracking the market, there's been a few success stories, but for the most part, anytime a developer does 3-bedroom units, they either sell to affluent buyers on upper floors, they might sell to an investor looking to rent by the room, but they almost never sell to families because they require 20% down payment, and the building is not going to be done for 3, 4, even 5 years down the road. So it's and the pricing is, like I talked about, is so high. So there's just a million factors that have kept it from taking off, and I think it's still a long way off before being something that you regularly see.
Well, Ben, thanks so much for your insight today. It's been great having you on the show. Before I let you go, is there anything of interest that you're working on that you'd like to share with our listeners?
Sure. I mean, if anyone is interested in checking out my website, it's www.bullpenconsulting.ca. I do analysis with a company called rentals.ca. So I look at the rental market across Canada and specifically in the Greater Toronto area in terms of what's happening in rental rates and trends. And so I encourage any of the landlords that are listening here to put their listings on rentals.ca. It helps just increase my sample size to do analysis on. So I'd appreciate it. Anyone does that. They can find me at Ben Myers29 on Twitter. I'm always talking about the latest numbers and what's happening in the market, and maybe a little bit Toronto Blue Jays as well. So that's where you can find me.
Thanks for listening to another episode of the Burn Your Mortgage podcast. Besides being a podcast host, I'm also an independent mortgage broker. If you or anyone you know, family, friends, coworkers, or neighbors could ever use any unbiased mortgage advice or second opinion, feel free to reach out. Email me at Sean, that's SEAN, at burnyourmortgage.ca, or call or text me at 647-867-3711 for a free mortgage consultation. Also, be sure to head on over to www.burnyourmortgage.ca and sign up for my free weekly newsletter. As a small token of my appreciation, you'll be able to download my ultimate mortgage checklist on choosing the perfect mortgage. I look forward to hearing from you and helping you with all your mortgage needs. Once again, thanks for listening.
You've been listening to the Burn Your Mortgage podcast. Don't forget to subscribe on iTunes and leave a rating. Until next time, happy mortgage burning.